Okay, welcome to this episode of Real Estate Chat. Robert,
Yes.
if interest rate hikes stopped today, tomorrow, next week, what would happen to the real estate market? Do you know?
Yes.
Well, this is what we're going to talk about on this episode of Real Estate Chat with
Robert Eid.
and John De Perez. So welcome. We're going to load up this article that Robert shared, and it seems that somebody agreed with our last episode, and this person is Benjamin Tal. Well, Benjamin, of course, not related to our show as yet, but this headline, as yet, we're going to get him here one day. That's our goal. He says Bank of Canada should stop hiking rates now. And if you look at one episode ago, make sure you like and subscribe to our channel. We put stop rate hikes as our heading, because I mean, that would be the obvious thing to do right now. But this article came out yesterday, July 25. Today, July 26, as of when we're filming this. Big interest rate cuts ahead from the Bank of Canada if 2001 is any indication. This article that Robert shared with me basically talks about today's environment of high interest rates. We're at 5%. And back in 2001, when interest rates were this high, it was at 6%. Now, unemployment figures were talked about in this article are the various factors, inflation, all that sort of stuff. And if you remember what happened back in 1990, 2000, 2001, Robert, which caused all of a sudden a drop in interest rates.
Well, one thing that I sent into this fella to remind him that what he's neglected to think about is that on September the 11th, 2001, there was an earth-shattering event that threw everybody for a complete loop for 3 months. The fourth quarter of 2001 was dead because everybody wondered whether the world was coming to an end. So he's forgotten all about this, not mentioned once in that whole article. Now, what else happened is you had the dot-com bubble blow up in 2020. There's all kinds of things happening all the time. And so to draw a parallel and say this market equals this market it's a writer's adventure. Like maybe they write 3 things a week. And so this is one, and they published it. That this article had the interview with Benjamin Tal superimposed in it or shoved in it. This is what they do all the time. And we follow Mr. Tal. He comes to the real estate board all the time, and he's always got some interesting insights. And he's got some what do you call them, catchphrases and sound bites that are fascinating. And remember, this guy is not really the economist, head economist for the bank. He's the showman that goes around and does these shows on behalf of the Bank of Montreal. You got to remember that. He is a showman, and they've got him there as being a showman. He's not a white guy. He's a showman.
So you got to remember that basically a writer comes up with these articles, ties in historical events with what's happening today, and then all of a sudden you've got the solution, magic solution, stop interest rate hikes, start to drop them basically, but so many different factors happen. But we're not economists, we're not statisticians, we're not Benjamin Tal, we don't work for Benjamin Tal. However, Robert, if rate hikes all of a sudden did stop, and let's just even say that rates start to actually drop, what would happen to the real estate market?
Well, everybody second guesses, and everybody tries to find a way to buy on rumor and sell on news. So what would happen? Well, we're once bitten, twice shy, because that's what everybody thought was going to happen in January. So in order for rates to be dropping, that means that things are bad, because these boys that are making the decision, apparently the Americans are making the decision this afternoon, are looking in the rear view mirror at data to decide what they're going to do about the future. But everybody else is looking at what they're doing today and saying, oh, that changes the decision I'm going to make tomorrow. So we're kind of cross purposes. So in order for rates to not pause, but come down, will mean that they have some information that's already happened that's bad. And so they're saying, okay, we've done enough, and we're going to reduce course. So the consumer in real estate, residential, living in the house, thinking about buying a place to live, is very sensitive to all these things. And so if consumer confidence is shot, then it won't matter what they do initially with interest rates. So people saying, finally, that's over. how quickly are they going to bring it down to regular? But what's regular? Probably first mortgage rate is 4%, 4.5% is going to be regular, and no more 2%. Forget 2%.
Ever. So it'll never go to that rate for a very long time anymore.
Only when there's a crisis like there was. You had the
Mhm.
crisis of the 2008, the bank supply, the bank money supply nearly blew up. And if they didn't do all the crazy things that did, it would have blown up. And now they've kicked it down to now. And so now what we have is, can they do it again? That's why they're talking about the artificial money. That's why they're talking about the Federal Reserve's, the amount of anyway, it's all complicated, but
So it's just a matter
it
of
underlines everything. Everything is, you've got to know a little bit about it, unless you're just able to blissfully wander through the daisies and do things that don't concern the financial markets.
All right. So it's just a matter of time before we see what happens and what will happen to prices, what will happen to demand, and will consumer, like, I mean, if you look at it today, sales have been stable. I mean, they're dipping now for the summer season. Prices are dipping a little bit, but it's not the end of the world. But let's say, for example, we reach that point. Historically, what has happened when interest rates dropped? Do people start buying more? Do they enter the market? We know what happened when it was very cheap money. But what could happen to prices? Like right now, we're seeing stable prices. Will prices shoot up once interest rates start to drop?
They will wiggle up. They won't shoot up. There's an inverse relationship between the rate of interest and the average price. But if this comes down a little bit, this will go up, because you've got to, there's not enough and not all at once in order to make a big difference. It'll just be, maybe it's a reduction in the reduction. The rate of change will diminish, or the rate of acceleration will increase, but you won't see, like, it's not 10% change. You're going to see 2% rather than 1%.
So eventually
significant, but it's not.
Well, eventually we'll hit the 2022 peaks at some point in our next couple of years.
Well, for prices, we will, but not for that reason, though, because the money will be worth less. So you'll be paying more of those dollars to get the same thing. So the prices will recover. That's the whole plan. I think we even said that before. We won't say that again.
There you go. So there you have it. Once rate hikes stop, and in fact, if rates start to get cut, that is what's going to happen in the real estate market. It's happened before. Now tying 2001 events, 2008 to 2017 to now, these are all different occurrences. So make sure you make the right decision in the real estate market. Make sure you continue to like and subscribe, and type in the comments if you have any questions for us on Real Estate Chat. We'll see you in our next episode, which will be Robert's forecast for July. We'll put that up in a day or two. All right. Have a good one. We'll see you next time. Bye for now.
Bye for now. Righto.